Every time your employer has paid your wages, they've been legally allowed to hold your superannuation for up to 90 days before passing it on, using it as a cash buffer for their own business. That ends in 2 weeks. From the 1st of July 2026, super must be paid every single payday, but there's a catch most people don't know about. Stay until the 8-minute mark. I'll give you a 2-minute super check that tells you whether your employer is actually doing it. This is the biggest structural change to superannuation in a decade, and it's happening at exactly the same time as another reform that will add a 30% tax on super earnings for a segment of Australians. Superannuation guarantee, the mandatory 12% your employer must pay into your fund, has been calculated quarterly and paid up to 28 days after each quarter ended. Your July and August wages could have their super sitting in your employer's account until late October. From July 2026, that gap closes completely. Super is paid every payday. No float, no buffer, no delay. Running simultaneously, Division 296, the extra tax on large super balances. If your total super balance exceeds $3 million from the 1st of July, you'll pay an extra 15% tax on earnings above that threshold, on top of the 15% your fund already pays. Effective rate on that slice, 30%. Balances above 10 million, 40%. These two changes affect very different people. Stay with me. In the next 2 minutes, I'll tell you which one applies to you and what to do about it. Let's start with Payday Super, because this one affects every employed Australian. Until now, most employers paid super monthly or quarterly. From the 1st of July, there's one option. Super must be paid at the same time as wages every single pay cycle, whether you're paid weekly, fortnightly, or monthly. Why does timing matter? 3 reasons. First, compounding. Money in your super earlier means more time invested and growing. Over a 30-year career, even closing a 6-week average delay on 12% of your wages adds thousands to your final balance. Second, protection. If your employer goes insolvent between quarterly payments, and employers have historically gone bust, owing substantial amounts in unpaid super, you lose that quarter's contributions entirely. Payday Super closes that window to zero. Third, enforcement. The ATO, the Australian Taxation Office, receives real-time wage reporting via single-touch payroll. From July, super payments will be visible the same way. A missed payment will flag almost immediately rather than 3 months later. Now, Division 296, the extra tax on large super balances. If your total superannuation balance across all your funds exceeds $3 million at the end of the financial year, you pay an additional 15% on the earnings attributable to that excess. On top of the base 15% your fund already pays, that's an effective rate of 30%. On balances above 10 million, the surcharge rises to 25%, making the effective rate 40%. But here's the critical detail. The earnings that trigger this tax include unrealised capital gains. If your super fund rises in value by $500,000 because the share market went up or a property held inside your fund was revalued, that's counted as earnings, even if you sold nothing. The tax bill is real, and it's due from your personal bank account or drawn from the fund, regardless of whether you have cash to pay it. Let me go deeper on 3 things that are being underreported. First, the enforcement shift that comes with Payday Super. From July 1st, the ATO will see non-compliance within 1 pay cycle instead of 1 quarter. That means employers who've historically treated quarterly super as an informal short-term loan from their employees lose that option permanently. For employees, this is straightforwardly positive, but it creates a real cash flow challenge for small businesses who've relied on the quarterly buffer to manage tight periods. If you run a business with a monthly payroll, make sure your payroll software is updated and your cash flow model reflects funding wages and super at the same time. For employees, the compounding gain from Payday Super is real, but modest in the short term. If you earn $75,000 a year, 12% SG is $9,000 annually. Closing a 6 to 8 week average payment delay at a 7% annual fund return adds roughly $80 to $100 a year to your super. Small individually, but across the workforce in a 30-year career, the aggregate effect is substantial. Second, the unrealised gains problem inside Division 296. Here's the part that's drawn the sharpest criticism from the super industry. Under the Division 296 earnings formula, earnings are calculated as closing total super balance minus opening total super balance, adjusted for contributions and withdrawals. That formula captures every dollar of investment growth, including growth in assets you haven't sold. For SMSF members holding farmland, commercial property, or private company shares inside their fund, this creates what tax advisors are calling dry liabilities, tax bills triggered by paper gains on illiquid assets payable from cash you may not have. Before you give up on the 8-minute mark, here's why this matters even if you're nowhere near 3 million. The precedent of taxing unrealised gains inside a supposedly concessionally taxed savings vehicle is new for Australia. Industry bodies have raised the question of where the threshold might shift in future. For now, the $3 million line captures roughly half to 1% of members. But the mechanism exists, and the threshold is not indexed to inflation, which means over time, more members will cross it. Third, the timeline. Payday Super starts the 1st of July 2026. 2 weeks away. If you're an employer, your payroll system needs to be ready on that date, not shortly after. Division 296 also starts the 1st of July 2026, but the first assessments won't arrive until after July 2027, based on balances at 30 June 2027. For anyone approaching the $3 million threshold, that gives a 12-month planning window, but it needs to start now, not next June. Here's your 2-minute super check. 3 actions. Do these this week. Action 1, log into my.gov. Open the ATO online portal, go to Super and click on Employer Contributions. Check that deposits from your employer match what your payslips say. If your last 2 pay cycles show nothing, note the dates and raise it with payroll or report it to the ATO online. You have the right to have your super paid correctly and on time. Action 2. From the 1st of July, track your super funds app every pay cycle. Contributions should land within a day or 2 of each payday, see not 3 weeks later. If you're paid fortnightly and nothing hits your fund for 3 or 4 weeks, that's a compliance gap and the ATO wants to know. Action 3. If your total super balance is approaching $2.5 to $3 million across all funds, including your spouse's if you have a joint SMSF, book a session with a super specialist or tax advisor before the 30th of June 2027. The first Division 296 assessment will be based on your balance at that date. 12 months is not a long time to restructure assets or adjust a contribution strategy. This is general information, not personal advice. Your situation will depend on your specific superstructure, employer arrangement, and balance. For personalised guidance, speak with a licensed financial advisor or tax specialist. Do those 3 things this week. That's your check. If you want to stay across what's changing in super and tax this financial year, subscribe. New video every week. There's a plain English summary of the Payday Super changes for both employees and employers in the newsletter. Link in the description. This is the fine print AU, because someone has to read it.